Bob brings out this critically important point that, if you think about the U.S., which is, tilting some, but it's still the center of free enterprise and freedom. And if you consider the opposites, Russia, China, Iran, they don't have freedom. And so I must say most of my research is on monetary and fiscal policies in detail, but I can't in recent years I've taken a look at China, and I've come to some obvious conclusions and observations, and I've written about them for about 5 years, and they've all seemed to pan out. So my discussion today, my lecture, is entitled China's Economic Boom Unravels: The Costs of Rejecting Freedom. And so when we think about looking at China, it's really, almost like the poster boy for the benefits of freedom that it enjoyed for several decades of boom, and then the slamming of the door on freedom, and now its economic miracle is really unraveling. It's still the second biggest economy in the world, but it's definitely unraveling. So I'm going to go into some detail on this, and Bob, I'll try to address, not only details of what's happened and the downfalls of a shift from freedom to central control. Maybe explain why, but then get into some of the details on how it actually unfolded. Now that China's so big, its impact not just on China but the rest of the world. So we can go to the next slide. So China presents this extraordinary story of a sustained boom in the economy, and then a transformation to its current struggles. And it's like a case study of the benefits of free enterprise and freedom and the costs of this current regime shift towards socialism. So under Deng Xiaoping, China created this. It is a very odd, unique growth model, economic model, where it had been a totally closed economy, central control, no freedoms, no personal freedoms. People didn't own land, and the list goes on. And Deng Xiaoping opened up the economy, and it was very odd, but he allowed and facilitated a US-style market capitalism in critical aspects, not all, but critical aspects of free enterprise, while the leaders maintained central control. So it was this kind of a very odd dual model of US central control socialism that allowed running parallel to it US-style free open markets. And with this, really from the early 1990s, through after the financial crisis, like maybe 8 years ago, it sustained the strongest surge in economic growth in world history. And it lifted it from this absolutely impoverished nation to the world's second biggest economy, and the driver, not just of global growth, but also global trade. And then so what happens in 2012, President Xi comes in, and he goes back to his socialist roots as a child and imposes his rendition of the China socialist ideals. And he gradually starts clamping down on free enterprise and personal freedoms. And the results of this, it's stifled capital and labor mobility and innovations, and generated, as I will describe, major costly resource misallocations, rather than allowing markets to allocate resources. He relied on central controllers to target things and allocate resources. And as a consequence of this, the China's economy has really stumbled. And as I'll describe, its potential growth has significantly diminished. Next slide. Okay, so let's get into this. So Deng Xiaoping opens up China and embraces US-style market capitalism. And it's the latter that drove growth and truly eliminated poverty for hundreds of millions of people. He allowed private ownership of land and capital, and really allowed an incentive-based economy to operate side by side with a central command regime. And so China had this huge untapped source of cheap, underutilized labor. And this was redeployed into more productive export-related manufacturing. So basically what happened is literally tens of millions of Chinese people living in the Western provinces, barely eking out a living, were migrated to the Eastern provinces that were the manufacturing centers. And there was heavy investment, both by the companies that blossomed and the government, and so and this generated tremendous gains in productivity. Plus, with the U.S. style free enterprise, you not only had heavy investment, but you had enormous inflows of capital and technology and just business know-how that helped improve the efficiency of production processes. And this led to innovations that truly transformed the economy and boosted productivity. And so during this period from the early 1990s through, say, 2015, it was the west to east migration of people was the largest in world history. And so you can go into all different angles on this, but when you add it up, it's just private ownership and labor mobility, cross-border flows of capital and technological innovations, and it all equaled just this ongoing surge in productivity and progress and wealth. And what the Chinese leaders did right is, once again, while allowing free enterprise, their central command also used the increasing wealth to build the modern infrastructure and invest in education and productivity enhancing technologies. They invested tremendously in innovation like rapid rail and transports to distribution points. They just did a lot right, and it worked. And they had year after year of 10% growth in real terms, in inflation adjusted terms. Okay, next slide. Okay, so China becomes the hub of global manufacturing. And they have, once again, this ready supply of cheap labor. And they're improving their production processes and building huge production facilities. They become the global driver of growth and trade. During 2000 to 2014, they accounted for 30%, if you can believe it, of total global growth. And its share of global trade rose from 4 to 14%. This is just enormous, just overwhelming. And like other countries that emerged, they started with low value added manufacturing, then they transitioned to higher value added, and then they became invested in leading edge technology. And as you know, they acquired both by legal and illegal means foreign technology and know-how. And once again, they invested very heavily. They invested heavily domestically on production facilities, on labor skills, education. And then they invested very heavily on claims. Globally, they invested in claims on needed natural resources in their production processes. And then really beginning after the financial crisis, they expanded internationally to emerging nations through the Belt and Road Initiative that's ended up being quite a failure. So when China was so far below its productive capacity, the government could allocate resources in almost any way they want, and it looked good, and it provided high rates of return. Okay, next slide. So by 2000, the decade before the financial crisis, the decade of the early 2000s, it really was the decade of the China super cycle, where you had like 10% growth year in, year out. And China was consuming so many of the global national resources, and future claims on them. And so commodity prices zoomed, and China really became the center. And so they were forming, the businesses there were forming joint ventures with around the world with US, European, Japanese, and of course Taiwanese businesses, and absorbing, I guess that's a polite way of saying it, absorbing their human know-how and technological advances. And then along comes President Xi, who gains real control, and he starts imposing his socialist ideals, which is really strange. And he starts clamping down on free enterprise and freedoms. And he does so, and it was most apparent around 2017, 18, when he started clamping down on the innovations of the most productive businesses, the high cap social media firms, where what the social media firms were doing is they were so extraordinarily efficient and very profitable and employed so many people. But if you think about the social media firms, their goal was kind of open economy, freedom of expression. And this became antithetical to President Xi and his control. So he started clamping down on those. And so here's the question. Here's a critical question that we may never know the answer to, but did President Xi view this shift in 2012 as a trade-off between economic growth and political control? That is, did he say, my goal is to move back to my socialist ideals with a central controlled economy and taking away personal freedoms? Will that involve a sacrifice in terms of economic growth and economic performance and standards of living? My read of it is probably not. He probably believed that they could move to socialist ideals and it would be totally compatible with sustained economic growth. He has one big problem. They weren't. And so the last 8 years has been a textbook study on how taking away personal and business freedoms and clamping down on entrepreneurship and technological advance is costly. So others may have a different view of this, that President Xi was willing to sustain lower growth in order to maintain control. But as time has gone on and as the economy really, really faltered, he's only tightened the grip on freedoms, taking them away, and suggests that his top priority is freedom. And so now, even though he knows now there's this trade-off. Okay, next slide, please. So what does this mean? Okay, so the National People's Congress in China, the State Council, sets national plans and economic objectives, and it directs the Chinese Communist Party to manage and achieve their plans. And by the way, on an aside, Bob, I remember maybe 12 or 15 years ago, there was an article in Foreign Affairs by the Council on Foreign Relations, and it asked almost tongue-in-cheek the question, does CCP stand for Chinese Communist Party or Chinese Capitalist Party? And because everybody knew that it was the capitalism that was driving China. So corporations that had achieved freedoms and were able to pursue their own objectives, now they were perceived by the state council as existing to further the goals of the state. And conflicts, as I mentioned, arose between Xi's desire for central control and the very highly successful tech companies, particularly those like Alibaba, Tencent, and the others that promoted individual freedom. And these steps undercut the most productive sectors in the economy. They put constraints on labor and capital mobility and innovations and personal freedoms. And as I'll describe, they led to major resource misallocations. And at the same time that China started facing these self-imposed domestic problems, there was a growing international backlash against China's violations of international standards of trade and intellectual property protections. And this led to a cutback in capital and technological transfers. So a lot of countries and companies became reticent to enter into joint ventures with China. They started cutting back their foreign direct investment. They started viewing more cautiously their transfers of know-how and technology. Next slide, please. So at the same time, a country that had achieved to be the second biggest economy in the world can't grow 4 or 5 times faster than the rest of the world forever. And so its successes resulted, as the labor supply became absorbed, and its successes, this dramatically pushed up wages, and there was a slowdown in the rate of productivity growth. And you combine those, and it resulted in a rise in production costs relative to overseas competitors. And this is just a natural phenomenon. And so once again, as China's economy grew, it was rising toward its capacity. And as you get closer to capacity, then the government's resource allocations become more problematic. Meaning, when you're way, way, way below productive capacity and you invest in a infrastructure, even if some of it's wasteful, it does generate high returns. But as you get closer to productive capacity, you get diminishing returns. But here, Bob at the outset mentioned that China's GDP had reached, say, 75% of the US's. However, if we compare it to Japan post-World War II allocated its capital and the capital it received from overseas very efficiently. And from just after World War II up until the end of the 1980s, its rate of economic growth outpaced the rest of the world, and its GDP per capita rose close to other advanced nations. However, China's GDP per capita remains a small fraction of the US and other advanced nations. So if you look at total GDP, that you have to spread that out over 1.1 billion people. On a per capita basis, China is still in that middle, actually lower middle income class area, with very large inequality in the distribution of income and wealth. Next slide, please. So this I just show per capita real GDP in the US, and it's about $65,000 or $67,000 per capita. Israel, which I think is a little over 40 now, and China's, which is just above 10,000. And so the critical question now is, will China emerge from its what growth economists call this middle income trap? And the answer is it depends on what kind of regime they have. And that's the key lesson I want to provide to you today. Okay, next slide. Now, let's go back to what I had said. Potential growth in China is naturally subsiding, beginning 2012, 2014. So its potential growth is decelerating. And the central planners, led by President Xi and everybody who, wanted to make him happy and align with his power, they made this. They used to target GDP every year, and they would announce it globally. And they targeted their real GDP way too high as potential growth slowed. And at the same time, they announced there was going to be this aggressive transition toward domestic consumption and services and away from relying on exports. Well, what happened? The transition to consumption failed. And so the private domestic economy fell well below the growth targets. So how did they achieve the growth targets? They achieved it by increasingly aggressive government purchases, government investment. So if you look at a composition of GDP, it became more and more uneven and more apparent that the way China was achieving its GDP growth targets was through more and more government investment, and government purchases are counted directly in GDP. And so the way it works, it's their fiscal structure is different than Israel's or the US's or Europe's, where you have a national government that conducts monetary and fiscal policy. In China, basically, you have the Chinese Communist Party, and it has at its top President Xi, and then it had all the government leaders at the cities and municipalities are communist bosses. And Beijing sets the growth targets for the local government officials. And they gave them growth targets and said, okay, hit these growth targets for this year in your municipality. And of course, the local government officials were all communist member parties of the Communist Party. And they wanted to make Beijing happy, because if they weren't happy, the local government officials would lose their jobs. And so how did they achieve their targets? Basically through land development and construction. So building infrastructure, but also a lot, as I will describe, building and overbuilding residential space. And this resulted in this huge imbalance, a massive government investment in infrastructure and real estate, and a booming construction sector. Okay, next slide, please. This just shows, compared to Euro area, Japan, and the US, what China calls, it's actually the China National Bureau of Economics, gross capital formation as a percent of GDP. Now, they do not distinguish between business fixed investment and residential investment, which is building of residential houses. And so it's all mixed together, but you see it's just totally out of whack here. I don't have a good chart, but if I had it, you would see China's consumption as a percent of GDP is still below 40%, whereas in US and Europe, in the US it's 65, in Europe it's about 60. So let me give you another comparison. In the US, residential investment, which is the cost of building new homes plus the cost of repairs and renovations, adds up to about 4.5% of GDP. In China, it was toward its peak, 25%. Okay, next slide. Okay, so how was all this financed, this housing boom? Okay, so Beijing would provide fiscal transfers to the local governments, but they weren't sufficient to achieve the local government, their goals they were given. And so the local governments, what they relied on was local taxes, but they also relied very heavily, up to 50% in some cities, on revenues from selling land to developers. And then they also issued bonds to finance the boom they needed to execute in order to achieve their year after year very lofty output numbers. And so Beijing created what I'll call a shell game. And so they created these local government financing vehicles to provide loans, or stated differently, to buy the bonds that were issued by the local governments. And these local government financing vehicles also made direct investments in real estate. And these LGFVs, how are they capitalized and financed? Well, their bonds were bought by private wealth managers who offered Chinese citizens higher rates of return than offered by SOE or state-owned enterprise banks. So basically, I'm getting this whole financial structure in China where, once again, a private command and control economy, SOE, the six biggest banks would control most of the financial assets. And they would, even when real GDP was over 10% and you had a few percentage points of inflation, the SOE banks would offer like 1 or 1.5% yield on deposits. So they were basically stealing money from their citizens. There were very few opportunities to invest elsewhere, but they did over time allow private wealth managers on a limited basis. So the private wealth managers went to their clients and said, we can offer you these bonds issued by local government financing vehicles. And so everything worked beautifully as long as real estate kept on booming and expectations about real estate remained strong. So, like 10 years ago, you would go over to China and all you would see is building cranes everywhere. Some people joke that building cranes were had become the national bird. Okay, next slide, please. Okay, so this next slide just shows you a chart. We'll get to it in a second. The next slide just shows a chart of the different layers of China's government debt. And so if you look at the blue down below, you'd say, oh, the government's debt, national debt as a percent of GDP is so low. Boy, everything's in good shape. And even if you add to that, the local government, the orange line, is still low. But then you get up to the green, which is owned by the central bank, and then this LGVF just has this huge amount of debt, and it's all a shell game. And so basically what happened is, once the citizenry started realizing that there was just literally tens of millions of empty apartment buildings that had been built by developers, that had been subsidized by local governments. Once they realized there was this huge excess supply, expectations shifted down. So demand for real estate fell. And then all the financing crumbled, and Evergrande, which was the largest, but like 90% of the 20 biggest land developers in China went bankrupt. Okay, next slide, please. Okay, now what are the implications of this? Okay, so obviously a direct hit to real estate. And I know I'm giving you a lot of detail about what transpired, but it's once again, the government, because it centrally tried to manage the economy and set targets rather than letting markets to determine outcomes. It set the wrong targets. It forced government officials to pursue them. And as the Friedberg's Economic Institute will tell you, government bureaucrats tend to all be similar, and they can't pick the best projects. So things unraveled. And so these excesses were created by the government. And then when things started to unravel, it was a direct hit to real estate. So you see this sharp decline in construction and falling prices. Household net worth gets clobbered. And by household net worth, normally we think of household net worth as savings, total stock of savings, stocks that are in stocks and bonds, real estate, private investment. In the US, household net worth, only about 25% of it is in real estate, and the rest is stocks and bonds and private investment. In China, that portion got up to 75%. So household net worth gets clobbered. So it just absolutely clobbers household balance sheets. And this leads them to, they're forced to save more and spend less to repair their balance sheets. And we're still in that process now. At the same time, confidence falls. Most Chinese homeowners know the problems. So they become much more cautious. Now, fourth bullet down is really important because, as I mentioned, the local governments and the government in general had relied very heavily on land sales to finance their budgets. And so now land sales are falling, and the demand for land sales has just completely fallen apart. So this major source of revenues disappears. And so when now you read in the newspaper, and this has happened for the last 2 years, you read about the need for more government stimulus to prop things up. But basically, the Chinese government can't afford the stimulus now because of the structure of their government finances. And so instead of offering big, huge stimulus packages, they're offering smaller packages through communities, and it's just not working. And so the other issue to bring out is, like, when there's a huge excess, and this happened in the United States, the debt-financed housing bubble before the financial crisis, the markets were allowed to clear the excesses. And this led to a lot of losses. But here, the Chinese government is trying to manage the unwind, constraining market forces. And this is going to elongate things and create some longer term problems. Okay, next slide. How long is it going to last for? Well, we have two recent historical examples of excesses. In Japan in the late 1980s, their potential growth after 4 decades of boom started to slow down, and the Bank of Japan tried to pump things up, and it created a bubble in asset prices, including real estate and the Nikkei. And it took over 10 years to clear up the mess. There was a whole decade of Japan calls it the lost decade now, of periods of on and off recession, on and off deflation. In the US, following the debt financed housing bubble, which is also driven by the Fed keeping rates too low too long, that also was one of the factors that contributed to the financial crisis, and then an anemic recovery following that. So that was, I'd say 8 years that it took for households to adjust. And so I would say China's been adjusting negatively for, say, 3 years. It has many years to go, where households are going to be repairing their balance sheets by saving more and spending less. And now it's definitely aggravated by government efforts to try to mitigate the negative short-run impacts. Okay, so rather than let markets clear, they're interrupting it, and the latest thing they've tried in some municipalities is to offer tax credits to people who buy homes. And guess what? The initiative's fallen flat in its face. Okay, because it's going to take a long time to change expectations. And until expectations change, demand for housing isn't going to pick up. Okay, next slide. Okay, so look, let's stand back and think about where we've come so far. Okay, after this boom, China now faces much weaker domestic demand. And the weaker demand is due to weaker consumption as households save more. And also businesses aren't investing as much as they used to because they're more under the control of the government. And because the government finances have been hit hard, the government isn't investing as much. So the domestic economy is weak. Now, before the pandemic, China faced this other very large problem, and that is global demand for Chinese goods, that is exports out of China, had diminished. But then with the pandemic, there was a big increase in global demand. But now exports are weak. So where we stand now is China's economy, it remains the second biggest economy in the world. It remains the global leader in technology. And if you think about, what you would do if you were a communist dictator, you would say, okay, let's do everything we can to avoid a financial crisis. Let's try to keep the citizens as afloat and as happy as possible. And let's also exploit our strengths. And one of the strengths that China has is making EV, electronic vehicles. And that's what they're doing. They're making EVs, exporting them, not just to emerging economies, but to Europe now. And you're going to get to a point where there's oversupply, and prices are going to come down. But keep in mind that under the current regime, businesses lack flexibility, and there's less labor and capital mobility. And now China it's unfair trade practices, threats to international security, stealing technological advances from other companies, which is in violation of international rules. They've harmed themselves, and now they become more and more isolated. So what you see now is for FDI, foreign direct investment into China, is now falling. You have more and more companies from the US, Europe, everywhere, not only cutting back on foreign direct investment, but cutting back or being much more judicious in their joint ventures and sharing of technologies and technological know-how. in the US, the Biden administration has outlawed exports of certain advanced computer chips to China that has just stopped their production. And so all these negative impacts are swirling around. And so, okay, so next slide, Pete, please. So you see global trade's flattened out. It's having a big impact on Asian nations. And by the way, if you consider Asia, which includes Japan, China, all the way down to Singapore, Australia, it's the biggest trading bloc in the world. And that trade has flattened out. And it's also having a negative impact on emerging economies that export heavily to China. It's having a very sizable negative impact on Germany that had relied very heavily, too heavily, on exporting, particularly autos and auto parts for combustible engine cars to China. At the same time, China's international investment strategy through its Belt and Road initiative is facing big problems. China didn't give anything away. They charged onerous yields on their loans, and some nations are having a real tough time financing it. So the Chinese yuan and the renminbi has fallen. It should be a lot lower. And meanwhile, China realizes that to be leading edge, not just in economics, but also in defense, aggression, national security, it needs to build leading edge semiconductor capabilities. And that's what they're doing. So it's a very uneven, unhappy economy. Okay, next chart, please. This shows global trade volumes have flattened out, and this is really important. I mean, it's tremendously important. You see the total flattening out in global trade as the economy increases. The chart on the right just shows the U.S. Has much less exports of goods as a percent of GDP relative to the Euro area. And then the other point I would make, okay, next slide, please. The chart on the left in orange shows U.S. imports from China. And also in the green and blue show imports from Mexico and Canada. So the U.S. is actually pretty well positioned for a weaker China on economic terms. I'm not talking about diplomatic or national security issues. But I'll tell you what's interesting about this chart on the left. If you dig into it, while U.S. imports from Mexico have gone up and they've fallen from China, a larger share of the imports from Mexico have Chinese content in them. And you even see some Chinese companies moving some production facilities to Mexico. Now, what does that mean? That means if the U.S. imports goods from Mexico that are made by facilities in Mexico that are owned by China, the profits are repatriated to China, but China incurs a decline in manufacturing employment, and that increases manufacturing employment in Mexico. So I just thought I'd mention this. Okay, next slide, please. This I just have to put in, because one question you might have is, hey, you've talked about how negative things are in China. Why do they still say GDP is growing at 5%? And here's my response. And this isn't a new response. The National Bureau of Statistics, their data are unreliable. They print whatever numbers they want. There was a very visible display of what they do with statistics. A couple of years ago, youth unemployment rose, and it rose to 20%, and then it rose to 21%. And then the NBS just announced they weren't going to publish the statistics anymore because they weren't valid. And so for those who are in the work in financial markets who have to guess at what GDP is, what I've often said is estimating the official GDP is more of a guess at what you think the National Bureau of Statistics will print rather than a reflection of the true conditions. And my belief is China's now saying, oh, our growth is 5%. If it weren't for inefficient misallocations of resources now, their GDP would be growing at maybe 1.5%. And I'm not alone in this feeling. I'm definitely not. So the level of economic activity is very high, but they are paying a dear price for the clamping down on US-style free enterprise. Okay, next slide. I'm toward the end here, don't worry. Okay, so if we think about an economy's long-run potential growth in real terms, it's driven by labor supply, that's driven by demographics, it's driven by capital investment and productivity. And if we look at China, its labor force and population are now declining as a consequence of their long-standing one-child policy, which is another, extreme example of taking away personal freedoms. Its private investment is weaker, and the government is still investing heavily to prop up GDP, and that's leading to misallocations of resources. By the way, in the 1990s, after Japan's bubble burst, the government tried to prop up GDP, and it went on an infrastructure investment boom. They built, they used to call it, or cynics used to say, they're building another bridge, another road and another bridge to nowhere. They actually built an airport complex they never used. Okay, and then productivity gains are being suppressed in every which way. And so China has diminished potential, and it's still stuck in that middle income trap. But now keep in mind, add up everything I've said, and so the government has less resources, and it's allocating more and more of the resources to military uses, defense uses, rather than allowing free markets to generate new technological innovations and higher standards of living for citizens. Next slide. Okay, so this just shows what's happening. The population is declining. The population of working age people have been declining. And then these are just on the right, some simulations by the United Nations. Next slide. Next and concluding slide. So China's certainly capable of sustained high potential growth, but its socialist central control regime inhibits it. And so the bottom line here is it's the structure of a political and economic regime that's just critical in determining economic outcomes. And when we talk about economic outcomes, it's not just GDP, it's standards of living for the citizens. And the standards of living in China have really been constrained and diminishing over the last 10 years. And what we see day after day now is China under President Xi is, he's basically chosen authoritarian control, and that is going to predetermine poor economic performance going forward. And that concludes my remarks, and I'd be very pleased to take any questions you have, or disagree, or feel free to disagree with me.
I'm Yeshaya Rosenman, India expert. My question is the conclusion from all this, what China will do, the same conclusion as Nazi Germany, start a war with Taiwan?
Okay, so look, fair question. I don't think so. Maybe I'm too much of an optimist. Let me just tell you one other reason for China to try to take over Taiwan is it's the only way it can increase its population. Same as Russia, the population is declining. And so by taking over Crimea and now trying to take over Ukraine, one of its rationales is to increase its population, not just its control. Now, why am I more optimistic that they won't immediately try to take over Taiwan by military force? One, it would be very expensive. And by expensive, not just the armaments, that they don't know how the US and Japan would respond, but also they would almost instantaneously lose like $500 billion a year in exports to the US. They would be further cut off from technological know-how that they know they desperately need. So there's a lot. I think your question is valid. It's a scary question. But there's a lot of calculations, the cost benefit that would go in is probably going into their decision.
Thank you. Thank you very much.
Thank you.
My question is whether Xi's decisions, economic decisions, are towards being more communist as a country, or towards keeping his control of the Communist Party over China?
A great question. I don't know all the implications to the answer or your question, but I think it's more so his top priority is to maintain control over the Chinese Communist Party, which determines the allocation of resources and the like. So he has just amassed complete control. And I think, and once again, so once he has that control, he imposes his views on it, and everybody carries out those views. Please, what is your opinion on this?
I'm not sure, but I think that there's more of a personal benefit for him in doing these actions than actually becoming more communist, because we can already see in the past that these actions in Mao's era did not work well. So I don't think there's a communist benefit decision.
Right. I think it's more just central command and control.
Yeah.
And he's doing it through the existing government structure.
Yeah, it's kind of what happens when someone's maybe has so much power for so much time, maybe.
Well, and and so in my talk, I discussed the role of the local government officials. And I think that's important because you not only have the Chinese Communist Party, the state council on top, but every local government official is part of the Chinese Communist Party. And they're evaluated based on the performance of their municipality. And so President Xi has total control over what happens. And he's just built up this power base, and his DNA, his own personal DNA, is, his version of socialist, communist, or Chinese socialist ideals. And it's very sad. It's very sad for the citizenry. And I mentioned, like, when you think about the controls that he's placed on the big companies that are most entrepreneurial, that affects the high-skilled, highly educated citizens the most. And if you look at what's happening, the way China's completely clamped down and taken control of Hong Kong, you're seeing, an exodus of human capital from Hong Kong, and it's completely changing. And so it really has a big impact on society, and that's why I think, just observing what's happening in China, it's really a striking example of, the costs of moving away from free enterprise and freedom.
Hello, thank you for your talk.
Who are you?
I'm Guy. That's my name. I actually wanted to know.
Guy.
I'm a guy and my name is Guy. It's very confusing.
What you do?
I'm a software engineer in a financial tech company.
Okay.
Yes. So I wanted to actually know if you could share how this impacted, how these changes in the Chinese economy impacted on the ability and of external companies and individuals of investment in the stock market in China. Whether people still do that, if it's still available, if the options are still available, and if the amount of money that flows into and outside of the Chinese economy was influenced by these changes.
Okay, I am not an expert on this topic, but the Guy, in general, it has put up barriers to cross-border capital flows. If you're a Chinese citizen, you're limited, strictly limited on how much capital you can move out of the country. Okay. The stock market, you can invest in the stock market, whether you're a Chinese citizen or a non-Chinese citizen. But history shows that, I don't want to use the word rigged, but it behaves as a rigged market. And so you can definitely invest in a Chinese publicly held company, but there are definite, political risks of doing so. You can invest in a company that has the greatest future, the best technology possible, but it could, if that investment faces risks, either the firm being controlled by the government in some way or losing a critical capital inflow or know-how. So there's still capital flows, and you can still invest, but it's really constrained. Does that answer your question?
Yeah, I think so. Thank you.
I think the true answer to your question is you have to go almost company by company.
Yeah.
And by the way, let me add, China's still it's still the second biggest economy in the world. I mentioned some of the big large cap IT companies that have been publicly constrained. But underneath the radar screen, there are many, many smaller companies that are doing just fine. And you can invest in them if you know how.
Yeah.
Given what you've talked about tonight, it seems to me that all these discussions about the threats to the dollar as a world reserve currency and moving to the yuan is really not a very likely occurrence. So that's number one. So if you could comment on that. And number two, nothing happens in a vacuum. So the question is let's say from the perspective of the United States, where there's going to be elections soon. The last time Trump was in office, the thing that defined his posture towards China was retaliation, was economic retaliation. And it seems to me that really the answer to all this is revitalize economic growth in the United States. That's certainly what happened under Reagan, that ultimately really brought down the Soviet Union. And the United States, which grew 3.5% per year from 1950 to 2000, and is now growing 2% a year, where the Congressional Budget Office is now projecting that it's going to start growing under 2% a year. The most powerful thing they could do vis-a-vis China is to put these policies we're talking about in place in the United States and start growing again. So if you could comment on those two things.
Sure, Bob. Okay. So the first point is the US dollar is the reserve currency of the world. China, even if China demands of its bilateral trade partners that its transactions be conducted in yuan rather than, say, dollars, China is not a candidate at all for having its currency become the reserve currency of the world. I mean, if you think about the criteria you need to be the reserve currency of the world, you need an independent central bank. You need a freedom of cross-border flows of capital. And you need to be credible and confident and have the globe be confident of you. And China, it doesn't fit any of those criteria. Now, we have seen, if you look at the portion that you've seen an increase in transactions conducted in renminbi, but that the dollar remains the hard currency of the world. At the same time, keep in mind, Bob, Europe, its economy has really faltered. It faces major challenges, and it doesn't have, it has a very low probability of becoming a reserve currency. So I don't think the dollar is challenged as a reserve currency. I would also note that the dollar's been strong lately, and this gets on to another subject, but the U.S. economy has picked up, productivity has picked up since the pandemic, and so productivity's gone up, and economic growth has gone up while Japan and Europe have faltered, and so that's not only pushed up real interest rates in the U.S., but it's pushed up the real exchange rate. So you see the dollar is strong versus the euro or the pound or the Japanese yen. And now, once again, the Chinese government views its currency, as a symbol. But if you think about it, with the domestic economy weak, they would actually benefit by using the currency as a policy tool and allowing it to weaken. That would lower its production costs relative to overseas. Now, to your second question, I'm not a political analyst, but okay. So yeah, if Trump were to become president, he's already said and we don't know what he would do, but he's already said he would raise tariffs, particularly on China. And remember, when he was president before, that he dramatically increased tariffs globally, but raised tariffs particularly on China, and it led to a global trade war and a flattening out in trade. The one thing I would note now is the world is much more fragile now than it was in 2018. And the economic costs of abrupt increases in tariffs could be painful. Now, here's where I might part ways with you a little bit and disagree. The US went through, it's gone through 20 years of weaker productivity. I agree with you on that. But I definitely see a pickup now. And I see a pickup in the pace of technological innovation, as highlighted by AI, is really striking, and it's being implemented into commerce and society in a dramatic fashion, very rapid. And there are other signals that are suggesting productivity is going up, and you see it in the aggregate data. And at the same time, the workforce is fairly flexible, and there's been about 4 million new immigrants to the US, which is very controversial. And they too will eventually add to the workforce. So I'd say US potential growth in the next, say, 5 years is much higher than the Federal Reserve projects, and probably higher than the CBO projects. So I think the US is on the right track there. Let me add one other point in terms of retaliation. President Biden has clamped down on China in some very aggressive ways, disallowing exports of specific, high-tech semiconductor chips that are critically important to Chinese production, particularly in military uses. That's the type of kind of surgical retaliation that my guess is Trump would employ to retaliate against China. So that doesn't mean there's going to be clear, smooth sailing in global diplomatic circles in coming years.
Okay, thank you, Mickey.
Thank you for having me.